Hey guys, welcome back to the channel. Michael Garcia here, I See Life. Today, what I want to talk about is the indexing strategy. A lot of people are wondering, how does the indexing strategy work? How does it protect your money? Is it a good strategy in the first place, right? And so, what I want to do today is actually separate the indexing strategy that you might find in some different contracts available to you from the contracts themselves, right? And the reason I want to do that is because I want to really break down, is the indexing strategy fundamentally a good idea, right? Does it make sense? And I want to separate it from the contract because unfortunately, you have to be aware that there are good, there's some good contracts and there's some contracts that are almost downright predatory, right? And so you have to pay attention to what company you're working with, what are their financials, what's their integrity, like their cap rate integrity. There's different parts to this, but what I really want to do is just really break down just the indexing by itself, right? And then if you guys have more questions about what kind of contracts would make sense for different situations, we can definitely get into that more one-on-one. But let's get into it. So when you hear the term indexing from advisors or agents, and it's referring to upside potential, right? Downside protection. So one thing I want to make clear is the agent or the advisor, they're not talking about index funds, right? So index funds are products that you would find in the market. They might, follow like the S&P 500. Uh, the indexing strategies are going to do something similar, but it's going to work definitely a little bit different, right? So that's what I really want to break down for you guys today, so you guys can understand what is going on with indexing, and you guys can make a decision for yourself. Like, does it make sense? Is it a sound strategy? And I'm going to say right up front, I believe it is a sound strategy. Do I believe um, got to watch out for certain contracts and certain wording, certain companies? Yes, absolutely. So that's what we do. We help people decipher the contracts, really understand what they're getting themselves into. But let's break down the indexing strategy. So what I'm going to do is let me pull up a whiteboard here. All right, so let's get into it here. So this is what happens in the indexing strategy. So typically you're going to find this strategy. You may have heard of fixed index annuities, so FIAs. You may have also heard of IULs or Indexed Universal Life. So you're going to find this strategy in both of those types of contracts. And so what's happening here is you are paying the insurance company a premium, right? And so they're going to take that money, and what they're going to do is they're going to go invest that into their general fund. Now, their general funds are going to be, a place where they grow their money, and what they do is they really want to grow your money very predictably, very safe. So there's not a lot of risk. What you're going to find in these general funds is generally a lot of bonds. You might find some real estate, and you might find a small portion of some more speculative investments where they want to take a little risk, maybe bump up the returns. But ultimately, what they're going to do is they're going to grow your money very safely. It might be anywhere from 4 to 6%. And so what's happening is they're investing the money in a safe general fund. You know, they're going to produce maybe, let's say, 5% return, just for an example, right? And so if the premium going in is $10,000, then 5% is going to equal $500, right? So then what happens with this $500 is they're going to go and they're going to invest it, or they're going to buy options, or more specifically, call options, right? So the indexing strategy is really an options strategy. And for those of you that don't understand options, I'll try to make this as simple as possible, right? Uh, Options are simply contracts. So when you buy a call option, what you're doing is you're buying a contract to buy 100 shares of a specific stock, uh, or index fund for a specific price, right? And the contract might be good for a week, it might be good for a year. There's different timelines, right? So in this case, what they're going to do is they're going to look at a year out. And what they're doing is they're saying, okay, we're going to buy this contract. We can exercise to buy at this price. It doesn't matter whether the stock market goes up or down, right? So to really make this simple, let's say you had a house, right? And you had $500,000 and you came to me and you're like, Michael, I want to buy your house for $500,000. Let's say right now that was the market price of my house, right? And I'm in California, so it's going to be hard to find a house at that price in Southern California. But obviously, other parts of the country, 500,000 might make sense, right? So let's just say, for example, you came to me and you said, Michael, I don't actually want to buy your house. What I want to do is I have this 500,000. I want to pay you 5% of that money as a premium, right? And remember that 5% came because you invested your 500,000 in a safe fund that generated 5%. So this is 5% that you're able to generate out of your general fund. And you're saying, I'm going to pay you a premium. I want you to sign a contract. It says anytime in the next year, doesn't matter where the market is, you have to sell me this house for $500,000. And so a year passes, and let's say the market shot up, right? And now that house is worth $600,000. Well, you're going to come to me and you're going to say, hey, Michael, remember our deal? Here's the contract. You have to sell it to me at 500,000. And so you're going to immediately capture that $100,000 of equity, right? Because you're buying it $100,000 below the current market value. And so you're going to capture that gain, right? So the same thing happens in the stock market. You're going to capture the gain of the stock. Now, Michael, what happens if the housing market goes down, right? So let's say the home is now worth $400,000. Well, if the home is worth $400,000, you're not going to come to me and say, hey, Michael, remember you got to sell this to me for 500,000. You're going to just let that contract expire, right? That contract essentially became worthless. And so you paid the premium, you didn't get anything out of it, but you did protect your money because you weren't completely invested into the market, right? Or into the house. And so you didn't lose the $100,000 like you would have lost in equity if let's say you bought the house cash, you paid 500,000 and now it's worth 400,000. So same thing in the stock market. If the market goes down, you are not gonna lose your money. What you're gonna lose is this $500, right? Because that contract became worthless. But remember, that $500 was generated from your original that budget. The options budget was created from your original $10,000 that you have in the general fund. So even though you lost that $500, you're still at a net zero, right? Because you still have the $10,000 in the general fund, right? And so you didn't actually lose any money. And this is how these indexing strategies can give you the upside potential, but they can also protect you from losses. So what I want to do is actually show you the investment pyramid here. And so if you look at this investment pyramid, right, the idea here is what is a sound way to build, structure your risk in your portfolio, right? So in the investment pyramid, you see you have this large base, right? And it's low risk, it's safe money, it's growing. And so this is going to be your foundation, right? And then what this is going to allow you to do, remember, this is going to generate, let's say 5%, just like in the index, in the general fund, right? By the way, cash value life insurance would be considered savings, CDs. These are all low risk vehicles that you can generate money, right? Interest. And so you can take a little bit more medium risk. And then at the top of the pyramid, you have the small portion of high risk, right? And I tell people the reality is a lot of people make a lot of money on the high risk investments, but the problem that you see with most people is most people take too many chances, right? They do not establish this low risk investment. Um, they go straight to the high risk investments. They throw all their money in crypto or on options trading or a specific stock. And so, unfortunately, what happens is if they blow that money, if it doesn't work out for them, they have no foundation uh, to stand upon, right? And so they take that loss and they're back to square one, right? They're back to zero. Whereas if they would have built their pyramid and structured their portfolio and structured their risk, they might have a foundation that is continuing to earn them that 5% year after year. And if you're earning that year after year, then you can take these high risk investments more often because you know that you have multiple opportunities because you have this foundation that's generating funds for you too. And so if we can compare this to what the general fund and the option strategy looks like, the general fund would be your low risk, right? It's generating at 5% year after year. And that's allowing you to take high risk investments right now. Options, make no mistake about it, options are high risk investments, right? It's an all or nothing investment. You're either going to capture the market gains or that contract's going to become worthless because you are buying an expiring contract. Now, there might be other high risk investments that you might feel are better, right? You might really believe in a startup company and you might want to risk money in that, right? And just buy the stock outright. And so there's different ways to approach this. But one of the things I like to point out is like, hey, Apple, and I know this has nothing to do with indexing, but if you would have invested in Apple a while back, 15 years ago, 20 years ago, you'd be a multimillionaire, right? Tesla, another like 10 years ago, right? Bitcoin back in like 2010, 2011. Last 5 years, if you would have invested in Nvidia 5 years ago, you would be balling today, right? Because you were able to stay in those high risk investments. And so what having this foundation allows you to do is take those risks over and over again, right? So you really want to establish this. And so I think the indexing strategy actually falls in line with this really well because you have that money in the general fund on the low risk part of your pyramid. So it's protecting that downside protection. But you're able to take those risks with the options and try to capture market gains. Now, I will say there are some indexing strategies that are definitely better than others. Please go ahead and watch the Indexing 101 video on my channel if you want to learn about the histories of the indexes, how they actually work like in depth. Today, we're really talking about the fundamental strategy. Like, does it make fundamental sense, right? And according to this, I would say yes, right? So just to give you an example, what I want to do, show you this here. So this is just an example of how the indexing works, right? So you are buying an option. So the first year you see the index went up 10%. And then the next year you see the index went down 15%. And the third year, the index went up 3%, right? So in this example, it's going to assume a 5% cap. You can see that right here. So what that means is you're capped at a certain level. So there's cap rates, there's par rates, and there's spread rates. Cap rates just basically mean you can earn up to the cap. Spread rates mean the insurance company gets the first portion and you get everything beyond that. And then participation rates, let's say if you had a participation rate of 75%, participation rates mean you're participating in 75% of the gains. So if the market did 10%, you're going to get 75% or 7.5% gain, right? So in this case, if you had a 5% cap that first year when the market went up 10%, you would be capped at 5%. So you'd earn a 5% credit, right? So now you're at $105. Now the next year, it went down 15%. And so what happened, remember, you're in an option strategy, your money's still in that general fund, so you're going to get a 0% credit that year. So you're not going to take any losses, right? And so if we didn't take a loss, we get to stay right where we're at. We're still at $105. And then if we had a 3% gain the next year, you're going to also capture that 3%. So the other part that I like is you have this renews every year, right? It's an annual, it's like an annual provision that says, hey, these options expire and we're going to invest in a new option strategy. So even though the market was down, it doesn't have to come back up to where you are before you start capturing the gains. You can still capture this 3% gain right here, right? So what that looks like, you had 105. When the market dropped, you stayed at 105, and then you continue to grow the next year. So you're at 108. So in this example, you're actually ahead of the market, right? And that's what's going to happen after losses of the market or downturns in the market. You are going to be ahead. Now, in the long run, is this necessarily designed to beat the market? No, but I would say it's competitive, right? And I think it's going to be very advantageous for people, especially closing in on retirement, that they really cannot afford to lose money. If you were to take 2008 as an example, it took 5 years for the market to recover before you could capture any new gains, right? So imagine being close to retirement, losing 40% of your portfolio, and then having to wait a total of 6 years in total before you were back to break even, right? So that's where I really feel this is very advantageous for people that really want to protect their money. They don't want to take any losses or have any, they want to be they're very cautious, right? They're conservative investors. And so here's another example. So it's not always a 5% cap, right? Like you could have larger caps. In fact, we have some great contracts that do have larger caps and they're locked in for the entire contract, which you don't get in every single contract. So please beware, like don't fall for illustrations and numbers that projected numbers, because a lot of times those are fake numbers, right? In fact, they are fake numbers all the time, because the market does. It's not how it's going to perform in general, right? But if you have a good contract that says, hey, these cap rates or these par rates are not going to change for the entirety of this contract, then you're going to have a more accurate illustration of what you are looking at, right? So the reality is, you can't predict the future no matter what. It just has to make fundamental sense that you're going to protect this money and continue to grow it, right? And so in this example, again, another one, this time you earned 10%. You see, you went from 100,000 to 110. And then we're going to look here. You see there's a negative 20 in the market the second year. So again, we got locked in at 110. We don't take any losses. And so if we were to take this 20% loss from 110, that would be $22,000, right? So that downside protection was worth $22,000 in this example. And then we were still able to capture the 9% the following year because remember, it resets itself, right? And so we can capture, we go up to 119. So we're well ahead because in this example, right, even after the 3 years, we're not back to 100,000 yet, right? But in the indexing strategy, we're at 119,000. We're ahead. And like I said, is the market going to have bigger years and outgrow the index at times? Absolutely. But it's what makes sense for you, right? Are you in a place where you want to protect your money? If so, these could be a great option for you. The next question would be, okay, well, what contracts make sense? Because although this is the indexing strategy is a sound strategy, there's the other component is, okay, what's in the contract, right? Because there's definitely a lot of contracts with a lot of variable moving parts, right? A lot of times those moving parts they're gonna be in favor of the insurance company. And so you want to make sure, hey, you have a strong contract. You might be looking for certain guarantees. And so that's where if you want to go review any contracts, you want to send those contracts to us to take a look and see if they're, a good contract or just get a second opinion. feel free to email me, right? Feel free to reach out and we can go over that. But ultimately, what I wanted to just go over today was uh, the indexing strategy itself, right? Is it a sound strategy? And I absolutely would say yes. Um, is it for everybody? Is it the right strategy at all times? No, right? Like there's still um, there's a time and place for everything. I truly believe that. There's definitely a time and place for the strategy. And so if you want to discuss that further, feel free to reach out. And like I said, check out the other videos, like, subscribe, and I will see you next time.